Hi everyone, welcome to this month's webinar. We're going to be talking obviously about the UK property market as we always do, but importantly what direction it's going to go in. More and more often when the property market's going extremely well, people know that at some point in time it's got to come to an end. There has to be a point where the property market bursts. Now, to what level it bursts is obviously what we're going to talk about today. When it's going to burst, we're going to talk about today. And what it's going to do over the next few years. Can it continue to rise? Can it continue to increase? Again, they're the questions that we're going to answer. Now, of course, like we say with everything, nothing's perfect. We don't have an exact crystal ball, but we do feel that we are better placed to judge, because the reality is, one, not only are we in the industry, but nothing depends on whether we get it right or get it wrong. So many people got it wrong during COVID, but they had reason. So we always say with the Bank of England, they always overly negate things. So things are always pretty negative from a Bank of England perspective in terms of outlook. And then when it doesn't happen, they always take the credit for it. So without further ado, let's have a look at what drives the property market. And of course, do we think it's going to decrease? So first of all, for those of you that are new to this, and for those of you that haven't been on any of these webinars before, or potentially haven't been on one where we've spoken about the fundamentals, the reality is that the fundamentals are key. Now, there are three main fundamentals here. The first is taxation, the second is legislation, and the third, as you can see, is interest rates and liquidity. Now, if those three things change, that can affect the market long term. Other things out there are typically short term. So we always see, news, for example, Brexit we've had COVID. These typically can affect consumer confidence, but they are short term. They're not things that are long term. They don't change the long term structure of the property market. So typically they don't affect the market dramatically, consistently going forward. But these that you can see on the right hand side of your screen now do. So let's talk about them in order. So let's talk about taxation. So first of all, with taxation, it's like a snowball effect. If you put a negative tax on, it will slowly have a negative effect that spirals the market down. The same with positive taxation. If you decrease the amount of tax that you've got to pay on the property, you'll see a snowball effect where people start to get on the bandwagon. So everyone knows what the recent taxation was, and that was stamp duty. So the reality is that with the stamp duty, what basically happened is they thought that they needed to drive the property market. They thought they needed to spur the property market on, because one thing that you've got to understand is the property market is phenomenal for governments in a number of ways. Confidence, it gives people a lot of confidence when they're moving and things are progressing. People in their own homes and own their own homes. It gives people confidence, which means they go and spend in other areas as well. But it also drives in billions of pounds for the coffers in regards to stamp duty. So every time there's a home transaction that goes through, you've got to look at everyone that gets paid. So you've got to look at the fact that you've got the government being paid through stamp duty. So it generates a huge amount of taxation. It generates a huge amount of money for lawyers. Again, lawyers will be paying personal income tax and companies will be paying corporation tax. So again, there's more taxation there. And of course, it generates money for mortgage brokers as well, and banks and so on. So again, there's taxation there. So it generates, the housing market generates a huge amount of money for the government. So the reality is when they said that there's going to be a stamp duty holiday, we saw a number of people get on the bandwagon. But what happens then is then the newspapers and the media start to get onto the taxation. And then what basically happens is they start to sort of increase, and the snowball effect happens, and people think, I better go and, if I'm going to buy a property, I better do it now before the prices go up again. And then the next wave of investors go on, and so on and so on. So what we actually saw was probably people pushed their move dates forward. If they were thinking about moving in 1 or 2 or 3 years, they thought, well, actually, let's do it now because we can save X amount of money. And also it prevents us from getting in 3 years' time when the house prices could be a lot higher. So we saw, even though the taxation that people could save, stamp duty, was pretty minimal. Unless you're buying a property at 500,000 and your saving was 15 grand, if you're buying at the average price, your saving was maybe £3,000-4,000, give or take. So the reality is it wasn't a huge saving that made a huge impact, but it was enough to have that snowball effect. So that's what taxation can actually do. We then move on to legislation. And again, legislation are things that, for example, if the government come along and said something along the lines of, well, you can't buy more than one home, that would be a type of legislation. Stopping clients from overseas buying, again, that would be a type of legislation. Viewings, when they were restricted due to COVID, no one knew what was going on. So if there was another lockdown and there was legislation in regards to what we can and can't do in terms of viewings, that's a type of legislation that can affect the property market. And of course, the change in regulations to the market, because we know that the lettings market has dramatically changed in recent years. It's been harder during COVID to evict tenants, even if they didn't pay. There was a 6-month time frame on that rather than a 2-month. You can only charge certain things now, whereas before letting agents would charge for everything, even to the tenant. The reality is now they can only charge for certain things, but most of those, if I'm honest, have been put onto the landlord rather than the tenant. You can only take a certain amount of rent, only 5 weeks rent now as a deposit. So certain things have changed there. So legislation like that would, of course, potentially stifle the market or can accelerate the market depending on what they put on. In terms of the most important thing, in my opinion, is interest rates and liquidity. You can see here that interest rates is a big part of it, but also liquidity. We never really thought we would ever have issues with liquidity in the UK, but we saw back in 2008 and 9, the banks literally weren't lending. We were only talking about it yesterday. A lot of the people that work here and work for me here, they don't remember the queues that were going around the block for Northern Rock to try and get your money out. But the reality is that's, whereas we think that's unheard of now, it did happen and not too long ago. So liquidity had a big impact. And if banks aren't lending, the reality is the property market isn't moving. So what then has to happen is if banks aren't lending at a certain value, the prices have to drop to where the banks are comfortable. And interest rates as well. Again, if interest rates rise rapidly, again, we're going to have issues. That's the bottom line. If they rise rapidly, we will have issues. But the reality is, I don't think that we're at that stage yet where they need to rise rapidly. When we head back to years gone by, we've seen in terms of the interest rates and where they are, and we've seen things, interest rates now are 0.1%. They were actually over sort of 5.5% back in 2008. That's a huge difference. A lot of people now are saying that if we get, interest rates rise by 0.5%, that's going to be big. The reality is they were 5% more back in 2008. So I don't think we've got too much to worry about just yet. But as I say, my biggest thing that I'm going to say to everyone now is if we start to push up to that 4 or 5% interest rate mark, of course, we're going to see that impacted. But as I say, we don't think that we're there at the moment. What we actually saw between 2003, when the interest rate was at 3.75%, over the coming years from 2003 to 2008, it did head from 3.75 to 5.5. And again, that is obviously a bigger increase than what we're looking to see at the moment. We actually did a webinar previously, and we didn't think that the Bank of England would raise rates. Our reasoning behind that was because we feel it's been a bit of a fake market in terms of the furlough scheme. They've got 2 other chances to raise rates over the coming months. They've got one in December, one in February. They typically have 8 meetings a year, every 6 weeks, give or take. But as I say, they've got another one in December where that's going to be a bit more touch and go. But I think they'll probably hold on till February. They'll get the Christmas and New Year out the way. Once Feb comes, that's going to be D-Day in terms of deciding what's happening with rates. And I do think they will rise in Feb, probably to around about 0.5% from 0.1%. But guys, look, they're still at historic lows. 0.1% interest rate. 15 years ago, you'd have never thought that it would have got to that level, but that's where we are today. So what do we think is going to happen in the future? Well, obviously taxation. The stamp duty holiday has come to an end. Again, a lot of people predicted this cliff edge, which never happened. But the reality is that the stamp duty saving wasn't as big as people were making it out to be. It just had more of a media effect and a bit of a snowball effect there. In terms of overseas clients, one thing I do think will happen over the next 18 months or within the next 18 months or so is I do think that there's going to be another 1 or 2% put on overseas clients purchasing. What with everything that's happened, we need to raise money. There's been a huge spend. Our debt is higher than ever. So I do think that they're going to start to raise money from overseas clients in the form of stamp duty. At the moment, overseas clients have an extra 2% to pay, which actually doesn't have too big an impact because the UK market is still a great place to have your money, especially in property. But I do think that we're going to see a 1 or potentially a 2% rise in stamp duty for overseas clients within the next 18 months. I think that's something that's definitely being touted. As we head down to legislation, we don't actually expect any short-term changes. We actually feel that the reality is the government don't like to meddle in it too much. A change of government might see something slightly different, but we're not expecting that anytime soon. So we don't see the fact that there's going to be any legislation changes in either lettings or property purchases, anything major, I would say, to make any kind of impact whatsoever. But where we do see there being a change is obviously the interest rates. We still feel confident about liquidity, by the way, guys, we don't feel that we're going to have another sort of Northern Rock scenario. We don't feel that we're going to have any issues with people getting money out of the bank, but we do know that interest rates are going to change. So what we are saying to everyone is, if that you are on the brink, and if you're on the brink of your buy-to-let and you think, well, a 0.5% rise in interest rate is going to dramatically stump your ability to pay, then the answer is you don't buy. It's as simple as that. What does give us the confidence, though, is go back to 2005-06. You could literally self-certify, which in this current day and age, it seems insane that you could do this. You could walk into a bank, you could self-certify what your earnings were, especially if you were self-employed. You self-certified it, and therefore you declared your own affordability. So the reality is, if you could declare your own affordability, people push the boundaries, and they push the boundaries to the point where at the rate of 3.75 or 4, they're okay. The moment they start to get to 5 and 5.5 and pushing that, and especially obviously mortgages would have been higher than what the interest rates were, that is where they have a squeeze. And suddenly that's where we had this issue with people who typically shouldn't have got a mortgage, especially at the amount of money they were borrowing. They typically couldn't pay it back. So we saw a lot of homes become repossessed. And of course, then the spiral then is a downward spiral rather than an upward spiral. However, where we feel confident is that the banks have been really strict. We are seeing now people who have got comfortable affordability, both partners working, more than 8-9 times income, but because they've got 1 or 2 buy-to-lets already, banks are putting the squeeze on them. They're simply saying, you know what, we just don't want to lend to you, because the reality is if one goes pop, then the other 3 will. So banks are being a lot tighter. Typically, I would say overly tight. On some of them, they are probably being a bit too tight in terms of the amount of money that they're lending. They're also down valuing properties as well. So if you've got a property that's got round figures 200,000, we're typically seeing valuations come back at 180 or 190. Again, just protecting the banks. And what that means actually is if they down value your particular property, you will then have to go and put more cash in. And where that protects the market as a whole is if you put more cash in and you're suddenly putting 35 or even 40% deposit down on the property, the likelihood of you reneging on that mortgage is very, very slim. So what that does is that means that actually they can have less repossessions. Less repossessions means less of a downward spiral. But as I say, I feel that they will be raising interest rates come February at the very latest. December's still touch and go, but I still feel that in Feb they're going to raise it. As I say, we predicted the last interest rate decision. You might call it more luck than judgment, but no, we did say that we didn't feel that it was the right time, and we didn't feel that they would raise the rates. It was close, according to sources in regards to who voted for what, but the reality is that they didn't rise interest rates, and I personally don't think they're going to do it in December as well. But the Bank of England will be raising those rates, to say, by Feb latest, in my opinion, especially if inflation stays where it is. But I do think that inflation will sort of pull back slightly as we sort of head into the Christmas period and the new year. So where are the prices heading? That's the key to this. So if they raise rates quick, let's go with the worst case scenario first. If they raise interest rates quick, let's say we have a 0.5% increase in December and a 0.25% increase in Feb, and then the start of April we have another 0.25 or 0.5%. Suddenly that will put a squeeze on. because we might only be increasing by 1%, for example, overall. But actually, if people are paying 1% or 2% on their mortgages, for example, let's say people are paying 2% on their mortgage, a 1% increase will actually mean a 50% increase in your payments. That's the reality. It's not as if your costs just go up by 1%. They don't. If you're paying 2%, and you're actually going to now be borrowing at 3%, that's a 50% increase in your cost. So that's a decent chunk of outlay. So if they put them up rapidly, then house prices will stall. That's the bottom line. They're a lot more intelligent than that. We don't think that's going to happen. We think more often and steady is the way to go. So therefore, do we see that the property market falling? No, we still see a good 1 to 3 years of constant growth ahead. Savills have predicted 5 years of growth, Knight Frank as well, 5 years of growth. I don't think we're going to see the kind of price rises that we've had in terms of, the 10% in Liverpool and the 8% year on year in Manchester, 6% year on year in the UK as a whole. I don't think we're going to see that. But what I do think we're going to see is a constant 3 to 4%, maybe even slightly more. So what I do feel is that moving forward, the next 1 to 3 years is still money-making opportunities. And what you've got to understand is it's not about waiting for that best moment, because there is never a best moment. A lot of people during COVID didn't buy because they thought, well, actually, it's going to crash and there's going to be the best moment. Of course, now they're paying 10% more for something they could have got 10% cheaper 12 to 18 months ago. And the reality is they wouldn't have only had the property 10% cheaper, they'd have also had 5-6% of rent. So that's 15% they've lost out on a 200 grand property. That's £30,000. That's a lot of money. So the reality is there's never the perfect time to buy. There's always a good time to buy. And I still think it's a good time to buy. I really genuinely think that the prices will still go up. Even if over the next 3 years you made 4 to 5% income and 4% growth, if you're making 8% per year over the next 3 years, you've got 24% coming in. That's still better than any savings accounts, better than most people are doing in the stock market over a 3 year period. So we still feel it's a great opportunity to buy. But like we say every time, guys, it's all about finding the right properties, about finding that right needle in a haystack. It's not about saying, well, there's 300 apartments, I'll just go and buy one of them for the sake of it. Let's go and drive the price down. Let's get a furniture pack thrown in, free legal fees. We'll get whatever we can done for you in order to get the best proposition. And for those of you that can't afford it now but want to buy, look, there are off-plan opportunities. There are off-plan opportunities where you can essentially have 10% down now, another 10% in 9 months, and the rest on completion. So there are those opportunities out there. We have one not far from London, which is 10% now and 90% on completion. So there's definitely opportunities to be had. But as I say, overall, we don't see much of a change in the legislation. We don't see much of a change coming through in taxation, apart from potentially a bit more stamp duty put on overseas. But we do see interest rate rises. But I don't think they're going to happen as quick and as much as people think they are. Therefore, I don't see that it's going to have a huge impact in a negative way on the property market. I think it will just slow the rate of increase. When they do increase it, so I think we're looking at 4 years, 5 years to when we can start to see a significant increase in terms of pushing back up to those 4 or 5%. Then of course that will be the time when we have to reevaluate things. But as I say, as for the time being, I still think we're doing extremely well. So guys, it's kind of now over to you. Now, I was told last time that I missed some questions, so I do apologize. But we have a chat and some questions at the top. So if I stop sharing, because I don't want to share anyone's details. So let's have a look here. So you guys should have a chat and a Q&A. So if there are any questions, feel free to ask. Got one that's coming up here. In terms of areas, has anything changed in regards to where to invest? Not really, despite the fact that Liverpool's gone up 10%, Manchester 8%, obviously Sheffield lead, Belfast is in the mix there. Nothing's really changed, and it still comes, in my opinion, it still comes up that it's about finding the right property. So, for example, we're here in Canary Wharf, as you can see in the background. The reality is that it's expensive. It doesn't give a great return. However, if you find something here that is 10% below or 15% below, it makes a great opportunity. So it's still finding those individual apartments or those developments where they've priced it up to sell, not priced it up to make a huge amount of profit. And if you find those developments, no, I think that most cities will do extremely well for you. Also, you can even go into secondary cities and secondary towns, which are close. For example, we've got stuff in, West Brom, which is only 15 minutes from Birmingham, or we've got something in St Helens, which again is only 15, 20 minutes from Liverpool and maybe 25 minutes from Manchester. There are options there to buy, and of course, you're going to be buying at a cheaper rate. So yeah, we've got great potentials. Got another one here. Can I share a view of the letting market in the coming 2 years? Manchester City. Yeah, so that's changed quite dramatically during COVID. As you can imagine, a lot of people either stayed at home or they moved back in with mum and dad, and then they came back in. But what we're now noticing is that a lot of people are coming back in. There's actually a report that was published by Zoopla that said everyone's now flooding back into the cities. In terms of Manchester, what you've got to understand is the best demographic that you can aim at is the young professional. So, someone's 24 to 28, they've got a good bit of disposable income, they don't have much outlay, no kids in terms of outlays for that. And the reality is they've got more disposable income than most. So what we're now seeing is they are now in the mindset of, I'm not seeing friends for a number of years. I want to be in the mix of things. I want to be near bars, coffee shops, restaurants, because I want to actually have a bit more of a life than I had during lockdown. So we're letting stuff. When we actually let Trafford, when did that get launched? Probably May, June time they completed. It was slow to start off with, and suddenly within weeks, it took off. Now we put one on the market in Trafford and it goes. We put one on the market in the Loom. Within a day, we've let it. So we're actually seeing really good, strong positivity in terms of the rental side, in terms of the occupancy rates, and I do see it increasing as well in terms of what you're getting back. Freehold of leasehold for buy-to-let. Again, look, we're not going to, we advise on leasehold, and I'll explain why in a minute. Doesn't mean that freehold doesn't work. It depends on what you find. You could have a phenomenal freehold and a terrible leasehold, or vice versa. Typically, the reason why we recommend leasehold is we find that it's easier to let. We find that a leasehold is typically city centre. Now, bear in mind, if you get a leasehold on the outskirts, so let's say you typically have suburbia where people would move out to, commuter towns, where typically there are a lot of houses there, but a number of flats as well. Maybe in that area, you go for freehold because typically there are more houses. But we recommend city centre for a reason. We find that, if you look over the last 20, 30 years, the best places to buy in terms of growth, always city centre. And what we find as well is you will constantly always have a younger demographic who want to rent. They're not ready to buy yet. Maybe they don't have the money to buy yet. But the reality is they will want to rent in the hub of it, in the thick of it, in a city centre. I know when I left uni, I was in London straight away renting. And then when I was overseas, I was in capital city overseas for a number of years and renting. And then, of course, once I had a family, you start to think about moving out. But we want people who, as I say, have that disposable income. So we recommend leasehold, city centres as the way forward. In terms of an update on a particular development in St Anne's, when's it looking to complete? We actually sent out a video of this. You should have got this morning. If you haven't, let me know. But a video went out this morning from the developer in terms of an update. They are due to be on site. They've been heavily delayed for a number of reasons. From what I understand, first has been the Liverpool City Council not getting a Section 106 back. And secondly, let's call it as it is, it's probably organisation from the developer's part as well. So they're looking at a 14 to 16 month build on Block A, probably 3 months beyond that for Block B. But if you haven't received that video, let me know and we'll make sure that goes over to you. But they did release a video on that today. Guys, I've had one on the other chat. That's a good question. Is it easier to rent a 1 bed or 2 bedroom? Do you know what? Either. There's not actually too much difference. What I typically say is, in terms of renting, it's the same in terms of difficulty. It's straightforward. 3 beds I wouldn't go for in city centres. I think that's overkill. People, there's no point in buying a 3 bed. They would have that as, typically you'll have a young or a young couple in there. And the 2nd bedroom is great for maybe an office space, but a 3rd bedroom is overkill. So I won't buy 3. How I would judge it is if you've got a 20 to 30,000 pound difference between the price of a 1 bed and a 2 bed, no problem, go with the 2 bed. if the affordability is there. If you've got a 50 or a 60,000 pound price for a 2-bed, my advice is that's extortionate. For an extra, what, 10, 15 square meters, 100, 150 square foot, 60,000 pounds. That's ridiculous. So I would go for a 1-bed, because a 1-bed will probably give you a better return in terms of your investment. So it typically depends on the price that you're paying for the actual unit. But as I say, if there's not too much disparity between the prices, 1 or 2-bed works. If there is a big disparity, go with the 1 over the 2. And next one, in terms of interest rates, what if they went up to 10%? Yeah, guys, I think we're in a lot of trouble. If they head up to 10%, you're heading to late 80s times. That's the last time that we saw interest rates sort of head up to, well, they were beyond that, 15%, give or take. And of course, we had an issue with the property market then. A lot of repossessions. People could hand their keys back and go and buy something down the road for a lot cheaper within a day. So I don't think we get there. I think those times have passed. Back in those days, the government would set interest rates. That was then handed over to the Bank of England, because the interest rates were more political, and they always lowered interest rates coming up to elections. So people borrowed more and they had a feeling of more money in their pockets. I don't think we're going to get to 10%, guys. So I think we've got big issues if we're getting there. In terms of, the only reason they would do that is because of inflation. And I think if inflation gets anywhere near that, we're in a lot more trouble than worrying about the property market decreasing. But yeah, as I say, I think that maybe we'll see 1.5% over the next sort of 2 to 3 years, potentially heading up to maybe 3% over a 5-year period, something like that. Another question here: would I look at the prices of service charge before buying? Have these rose? So yeah, that's a good question, and it's tough to answer that because it depends on the development. If you've got a development that was done to a decent spec at the start, not over spec that is, but to a decent spec at the start, no problem. And a management company, you've got a good management company in who are maintaining, taking care of it, it shouldn't increase too much. We've seen developments which have been over spec. They've got swimming pools, gymnasiums in it, fantastic concierge services, workspaces, everything like that. Of course, these things have to be paid for eventually. It looks great at the start, but it still needs maintaining. Imagine the cost of a swimming pool, an indoor swimming pool being maintained, and the gym, how much that gets used. And then suddenly they become pretty much redundant because either it's out of action. So I always typically say, look, although those things are great on the surface, the swimming pools, the steam rooms and all these kind of things, typically they're overkill, because that particular gymnasium that you have in a building is never the same as the quality as a gym that you can get outside. As I say, there are certain benefits. It depends on area, but typically now that you can go and get a gym membership for £20 a month in Pure Gym, and some people just want a better spec. So I would typically say, yes, you do need to look at the service charge, but look at what also the other facilities are, because they can rise dramatically. But again, that depends. It's a good question, but it really does depend on the actual development that you're buying. Another one about service charge here, actually. We're experiencing very high service charge in city centre apartments. Do you forecast any reduction? Again, it's really tough to answer that without knowing the actual development. I can't comment. It's the same with anywhere. What I would always say is, under the Freedom of Information Act, you should be able to request what they're spending their service charge on. If you think it's too high for the service that you're getting, request it. I saw a service charge about 4 or 5 years ago, and it was extortionate. And when we broke it down, there was £29,000 for a caretaker. Well, the average wage in the area was probably about 18 or 19,000. So what they was doing, 29,000 on a caretaker, I don't know. And 40,000 was going out for internet, but they only had 5 internet lines feeding the whole block. So when we questioned it, it got reduced. Again, I'm sure that a lot of time the service charge companies and these management companies just add stuff on when really there's probably there's money that they it's not warranted. So you really need to just I'm more than happy to have a look for you guys, but it really does depend on the development. And also, some people think that it's really high and potentially it's not. But if it's over the top, you need to question. You need to get a breakdown. Don't just take their word for it. Get a breakdown of that. Do I think people will still be moving to small towns on commuter belts around London? Yeah, I mean, I think the demographics change. I think for people who typically had a 2 or a 3 bed in London, with a child, 100%. I think that those type of people are moving out. I think lockdown has made them realise, actually, we've got a child, we want to move out, we want the fresh air, we want parks on our doorstep and things like that. But we're also seeing the opposite. We're seeing people where they were living at home and they were living with mum and dad, or typically they would work in London, but typically they would go back and live with mum and dad, spending a lot of time there. That we're now seeing a big influx come in. Even with our guys in the office, we're seeing more and more people say, I'm moving closer to work. I want to, the moment I finish work, I want to be out, I want to be socializing, I want to be in the thick of it. So I do see people going both ways. I don't think that we're going to see less people in one particular area, but I see the demographic, changing. Can I buy a property as a non-resident? Yes, you can. There's nothing stopping you from buying a property as a non-resident. Mortgages will be slightly more difficult. You'll have to put a higher deposit down, 35, 40% and beyond. But yeah, from a legality point of view, look, you can buy a property as a non-resident, no problem at all. What do I need to do to buy a property? Well, you need to choose one first of all, and then you simply go through the legal process. You can either buy it in your personal name or you can buy it in a company name. But yeah, all of that will go through a regulated solicitor, but it's very straightforward. Again, feel free to get in touch to me direct and I can point you in the right direction. How safe is it to trust developers who promise a 7% or more rent warranty for 3 years? Yeah, good question. You know what? They used to be pretty good. They used to be some good developers out there who you could trust. More and more we're seeing it as a carrot that's dangled that doesn't come off. That's the reality. Two issues with it. First of all, mortgages. I don't want to say any names, guys, so I'm smiling. I don't want to say any names you haven't paid, but there are developers out there that just simply haven't followed through, and they've got away with it, which is insane. How a contract they can get away with it, but they have. First things first is that you typically won't get a mortgage if you've got a development which is offering a 7% or 8%, whatever it is, guaranteed rental. And this is not a student. I'm talking about residential. Student is different, guys. But let's talk about residential for the time being. If you've got a development out there that is 7% or more over a 3 year, 5 year, whatever it may be, that is going to be classed by a mortgage broker as an investor-led scheme. And a mortgage broker, they don't like lending on them because the risk. The reality is if you've got the majority in there who are investors, there is a risk to the lender. They see investors as more risk than residential clients. So the first thing you've got to take into consideration is you may not be able to get a mortgage on that. You may turn around and say, it doesn't matter, I'm cash. But at some point, you're going to want to resell it. And if you resell it and the person that's buying it can't get a remortgage, or a mortgage, I should say, well, then you're not going to be able to sell it. So you're limiting your market, who you can sell it to. That's residential. Student is different. You want a guaranteed rental on student. So no reason why you shouldn't be getting 7, 8, 9% on a student property. That's fine. That's no problem at all. I've only ever seen one be really painful. The rest are paid because student properties are always packed out. I've only ever seen one developer who's been really painful and delays. However, they did complete in the height of COVID. That's the only line of defense I can give them. They should have still paid, but that's the only line of defense I can give them. So it depends what you're buying. I say residential, I would say no. Student, I would say yes. What I think about Medway areas, particularly Chatham, Gillingham, yeah, they're good. Again, we've dealt in Chatham before, up and coming, decent location times. We've got stuff in Chatham. Where have we recently launched in Kent? We've got Ashford as well, which is again into Europe and of course into London as well. So yeah, there's nothing wrong with them at all. But again, it depends on the property. Again, I'm more than happy to have a look. If you're, some people can say, what do you think of Manchester and Liverpool? I think they're fantastic. But if you buy the wrong property at the wrong price, it's going to be terrible. So yeah, as areas, if you get a decent property at the right price, no, you shouldn't go too far wrong. So look, another one here on the other chat. I appreciate you're specialising in residential properties, although have you got any thoughts about commercial properties and offices? Is it worth investing at the moment? Yeah, so I do have an opinion on commercial, and I personally don't touch it. Not that it's a bad investment. My concern, if we compare them side by side, if you compare a residential property next to a residential property is always going to be a residential property and it's always going to be lived in. People always need places to live. As fashions change, everyone, well, the majority of people here of a certain age have known. I remember as a kid, the high street was the place that you bought everything. You know, if you wanted to buy something as a kid, if you want to buy, you know, pencils for your school, you went to Woolworths. Now you buy off Amazon. So things are changing. So whereas commercial property previously, you know, high streets were the things to get, suddenly it's now, well, people are going over to warehouses. You know, you've got Amazon warehouses, they've got huge warehouses where everything's stored, and the high street dies off. So commercial property isn't that in demand for a normal commercial property. And I'm sure you walk down your local high street and you see things changing all the time. You see, a closed sign on a new shop coming in, and the high street is a tough gig. It's a tough ask. So I certainly won't be buying high street commercial properties. Then you look at offices. Well, again, look, most offices were empty during COVID. And the reality is I get offered new offices all the time. And I know the prices pre-COVID and the prices after. The rental now, you can go and pick up really dirt cheap rental offices in London. They're slightly going to start to increase now as people are coming back in. But why do you want that? The reality is I personally won't buy commercial because there are always things changing. As we get more and more technology conscious and people can do their jobs from home, are we going to start to move away from offices? Are we going to do 2-3 days a week where offices need to be smaller? So if you've got people, you've got 100 on your team, potentially you only need space for 50 if they can hot desk. So personally, I don't feel as confident in commercial, but people are always going to need a residential property. How many years insurance? How many years do you get insurance on off-plan building? I don't understand what that question is. I'm really sorry. How many years insurance you get? I don't get that question. If you could explain that in more detail, I'll try and answer it. Is Milton Keynes area up and coming? Again, Milton Keynes is a good area. It's commutable into London. Often when I'm in Manchester or Liverpool, we go through Milton Keynes. I wouldn't say it's up and coming per se. It's a good area where you can make some money. I think there are Milton Keynes, as I say, it's a known area. It's not something which has just suddenly been put on the map. But I still think that it's a decent commuter belt town. It is commutable into Euston. Again, I don't think you'll go too far wrong. It isn't one that's known for the hub of buy-to-let, if I'm honest. If you're looking at buy-to-lets, it's not one that's known as, you know, this is the next buy-to-let. I think there are better areas than that for buy-to-let. But I say, I still don't think you're going to be going too far wrong. What's your view on buy-to-let in the Northeast? Sunderland, is it a good place to invest? Again, the Northeast has done extremely well in terms of Newcastle and Sunderland. What we have to look at, though, is the demographic in the area and the affordability. You'll soon get to a point where if you have too many investors going into the area, the actual locals get outpriced. And actually, they don't just get outpriced on the buying, they actually get outpriced on the rental side because the wages in the area is a lot lower than it is on the Northwest, sorry. Yeah, there are some good pockets there, but what I have seen is there's a development in Newcastle. I can't remember it off the top of my Hadrian's Tower. It might be. For me, it's choppy. It's overpriced. They're pricing, you know, 350 to 400,000 for a 2 or 3 bed. I won't be paying that in Sunderland or Newcastle. So what I have to say is it goes back to the same thing I said before. It's all about the price you pay. There's the majority of areas you invest in, you can make decent money, but it's about the price you pay. But some places, they just won't drive down. For example, behind me here in Canary Wharf, if you can pick up a 2-bed, which you can't, by the way, but if you can pick up a 2-bed at 400 or 500 grand, you can have a great investment. But you can't. They're going for well over £1 million. So the reality is it's all about the price you pay. Work out your rent, work out your outgoings, get your net rental, and say, is it sort of above 4%? If it is, you're going to be okay. We think we can get 4.5 to 5.5 to 6 on a traditional let, maybe 9, 10, 11, even pushing on a short-term let in certain areas. But as I say, you want to be looking about the price that you pay and what you're getting back. Pros and cons of auctions. Another good question. Typically, you can't always see the property before you buy it. Potentially, with an auction, you might be buying a problem. However, on the flip side, you can get good deals. However, there's a big flip side. You've got to ask yourself who gets the best deals. The reality is at an auction, if you've got a property, let's go around figures again, at £80,000, and you know that that property needs work, and you can go and sell that for £120,000. There's £40,000 profit in it. You might go along, and the difference is between you and a developer is the developer will be able to do that renovation cheaper than you can. So the developer might say, well, I only need to spend 10,000 on it or 15,000, and I can make that 120. Whereas you might have to spend 25 or 30,000 on it. So a developer can always outbid you at an auction. If this is a property that you're thinking about doing up, a developer will always outbid you, because if they're looking at making the same profit as you, 15, 20 grand profit, but their costs are a lot lower in terms of what they're building, they can outbid you. So typically, if you've got something that needs renovating and it's at an auction and you are the last bidder remaining, you've got to ask yourself, why hasn't the developer bid up to this amount? Because if it makes good money and it's a good renovation to be had, there'll be a developer in there that can do it cheaper than you can, and they would have bid on it. It means you're overpaying. If there is something that's ready now, looks perfect and fantastic, well, again, why has it had to go to an auction? Why didn't it actually sell before? So my advice on that one is just do as much due diligence as you can and get into that property if you can before. Some more questions on the other side. What's your advice on a holiday let? Yeah, do you know what? Again, everything's about location on holiday let. I think holiday lets are fantastic. Depends on the area. It doesn't have to. Everyone thinks holiday let has to be by the sea, but it can be a city break as well. So yeah, holiday lets are fantastic. We've got a trademark part of our business called Skylet. We trademarked that maybe 3-4 years ago, and yeah, it's been booming pre-COVID, and it's really starting to get going again. So holiday lets in the right area. We do Manchester and Liverpool. You've got 2 football teams in Manchester. Obviously, you've got Champions League games, and 1 football team in Champions League games in Liverpool. A lot of activity. So no, we think holiday lets are great, but it really does depend on the right area. And there are tax breaks as well. You get certain tax breaks, which we've covered before. If it's available for over 210 days, let for over 105 of them and not 30 consecutively, there are certain tax advantages that you get on that as well. So yeah, definitely something to look into. The recent 2% increase in stamp duty for overseas buyers, is that here to stay? You mentioned for another increase, this may decrease overseas buyers. Yes. So I think, yeah, it's here to stay. But I also think that they're going to probably add maybe another 1 or 2% to that, maybe just the 1. However, it might put off overseas buyers. I don't think it will, because if you're buying a property for £200,000 on average, which is pretty much where you need to be for an investment, slightly higher, slightly under will work, but 200, if that's only another cost of £2,000, that's 2 months rent. So the reality is that you might be charged another 2%, but that's only 2 months rent, and then you paid it off. So I don't think it's going to affect people in a negative way whatsoever. The majority of overseas buyers are buying in the UK for a reason, because it's a strong market, it's a stable market, your money's safe. So yeah, I think that's the main reason. Guys, looks like that's all the questions. Well, look, it's been an absolute pleasure. This is going to be uploaded onto YouTube and all of our channels. So feel free to take a look at this at any time. We'll send you an email with the recording, and look, take care. Have a lovely rest of the week. Bye-bye.